markets, speculation, and risk. This is the Chat with Traders podcast.
Yeah, that's right. This is Tessa, co-host of Chat with Traders, and we're on episode 298. How's it going for you? Thanks for tuning in to one of the first few original trading podcasts from way back, like 10 years ago. My co-host Ian Cox and I are honored to keep it going still due to your listenership, so thank you so much for your continued support. Today, my co-host Ian speaks with Christian Mayer, a systematic Forex trader who has worked on the institutional trading side in the past. And we don't get many Forex traders on the show, and I'm not exactly sure why, so maybe we'll have to change that. So Christian transitioned from equities to Forex, focusing on fixed size mean reversion strategies with some fundamental correlations where structural edge is statistically likely. His initial losses led him to a research and systematic driven approach and backtesting as well. He trades with fixed position sizes, wide stop losses, and avoids compounding to minimize exposure to fat tail risks and black swan events. Emotionally disciplined yet honest about the psychological strain of prolonged drawdowns, Christian blends rigorous quantitative methods with thoughtful strategy design. With a successful track record, including a second-place finish in one of the World Cup Trading Championships in the Forex category, he also created globalfxanalytics.com to respond to the demands of traders wanting to understand more about his Forex strategy and view his strategy's performance. Ladies and gentlemen, all the way from Munich, Germany, we're pleased to introduce Christian Mayer.
Hey, Christian, I'd like to welcome you to Chat with Traders.
Hi, hello. Thanks for having me.
So where are you now and where did you grow up?
I'm in Germany right now, actually, in Munich, south of Germany, where I also grew up. Yeah.
Uh-huh. And so tell us a little bit about your early years. When did you first start having interest in the financial markets?
That was probably my last year of high school and first year of university. So I studied economics with a minor in informatics. So I also learned how to program. And that was when I realized that I think I learned, people from my generation, probably many learned how to trade at the very beginning by simply Googling, how do you trade? And then usually the first thing that comes up is some sort of technical analysis very often. At least that's how it was for me. And that's when I thought, well, I'm also learning how to program. So nowadays, there's a lot of historical data out there that you can get for free, and you could potentially backtest these strategies that you can find very easily when you just Google technical analysis, for example. So that's how I first got into trading, and my interest peaked there. Yeah.
Did you know anyone else in the field, or did you just strike it off? Did you go solo, so to speak?
I did go solo actually at the beginning, so I didn't really know anyone else who was in trading. I think actually in Germany, it's people don't like taking risk, so there's also not such a large industry as in other countries. So yeah, I was definitely I didn't know anyone else in the industry.
So when did you actually open up your first trading account?
That was that very first year at university. It was a very, very small account. I think it must have been something around 500, 600 euros. So very, very small. But then again, it was my first year studying, and I wanted to test a strategy that I didn't backtest yet, but I read about on the internet. That was a technical strategy. That was basically I'm sure you've heard of the RSI, which is a technical indicator that shows oversold and overbought signals. And I tried that one out on equity indexes, which that was my very first experience with it. And that was probably one of the worst first experiences you can get, because it worked at the beginning, but I obviously didn't now I know that I didn't quite understand what I was doing, but at the same time you get rewarded. So that's why I think that's one of the worst combinations that you can have at the beginning. So it did work for a few months, and that's when I started thinking, wow, I found something incredible here. Until as many mean reverting strategies, it works until it doesn't. And at some point, the market started to trend, and that account unfortunately went to zero. Yeah.
What year was this?
That was year 2012. Yeah.
2012. So the market was trending up rather steadily at that time?
Yes.
I see. So the RSI showed overbought the whole time. Is that?
Yes,
yeah.
Yes. And when you short it, then and it keeps on trending up, that doesn't work so well in your account. At the beginning, it was working for a few times, and that's when I started trading more size, and that's exactly when it stopped working.
And so did you dive into any other kind of technical indicators or change up your strategy in some way?
So that was a very valuable lesson because I blew the whole account. So the next time I decided that I'm first going to do the research and really going to backtest the strategies, think about what I'm going to be trading before I actually put in real money. And that was when I really put in more time to learn how to backtest the strategy. I did that using R and MATLAB. That's those are just programming languages, and they're actually quite useful because they have a lot of libraries with which you can backtest a lot of strategies very easily. That's what I used, and I started backtesting a lot of strategies. So I was looking at the beginning, it was mostly mean reverting strategies. So that was the RSI, Bollinger Bands. I've heard you can use. I use them for mean reverting signals. It's also possible to use them for trend following, obviously, but in my case, I use them for mean reversion strategies. Then also the Larry Williams percentage, the stochastics index, all of those indices that are very, very similar, actually. They're all mostly mean reverting indicators. And that was what I was backtesting at that time the most. And that was also when I realized that for equity indexes, they didn't work as good as for some foreign exchange pairs, for example. I realized.
Why is that?
At that time, I didn't quite know why that is the case. I was just happy being able to find that out and not to do the same mistake again. Then afterwards, I started also researching more fundamentals together with the technicals. That was when I realized that a lot of these currencies were this RSI or Bollinger Bands or Larry percentage and so on works. Those are usually economies with that are highly, how do you say, that are highly interconnected. In this case, for example, an FX pair that I found that was very profitable with these strategies was, for example, the Canadian dollar versus the Norwegian crown, and that's mostly because both of those economies, oil exporting economies, they export a lot of oil. So as a result, they have a very high correlation to the price of oil, and since both of them export a lot of oil, you can also plot one currency against the other, and you will have what I would call a mean reverting time series, which means it's basically data that mean reverts, which makes fundamentally sense because both currencies should be going roughly into the same direction when the oil price goes up or when the oil price goes down.
When you noticed anomalies in this, when it didn't track oil for some reason, were you more tempted to increase the size of your positions to take advantage of it eventually catching up?
The first version of the strategy was quite simple. So I was just looking at these technical indicators, and I didn't even know about the possibility of, I didn't think of it at that point in time, that you can average in and average out of your trades. It was still very new to me, and the first strategy was very simple. When you get the signal, you go all in. And when you get the take profit, you go all out. So there was no averaging in or any sort of variable lot size that I was using.
So did you switch basically from stocks into foreign currencies?
Exactly. The basis for this was really the back test that I was doing. I saw that mean reversion tends to work on certain FX pairs. With time, when I was doing more and more fundamental analysis, that was also the time when I also started to get to know some people in the industry. I started to reach out to people on LinkedIn, especially a lot. You know how it works. You text, especially at the beginning when you're just a student, you text 100 people, maybe one or two reply. But that worked, and that helped a lot.
How long were you doing this for? Did you have a other job on the side, or were you making money just from trading?
That's a little bit difficult to answer because I was doing that since the beginning of my studies, and I'm doing it until now. So I've always been running this strategy.
So in other words, you didn't need to work a job on the side, or you were doing this, you were doing trading full time as your full time profession from the beginning.
Okay. Now I understand the question. So I wasn't doing it full time. This is a little bit that's difficult to answer because the strategy basically works on a very long term time frame. So it does on average about 10 trades per year. That's approximately one trade per month. So you can perfectly combine it with with a full-time studying or a full-time job.
Did you end up getting a job in the financial industry?
Yes. My first job out of university was at an investment fund that traded a long-term strategy on equities and bonds. Mm-hmm. And it was very much a very risk parity-like strategy, where you basically try to invest less in the asset that is currently highly volatile, and you try to invest more in the assets that are currently less volatile, simply because history has shown that volatility often has a very high so-called autocorrelation, which means if volatility starts going up, the probability is high that it will keep on going up for a certain time window. And the other way around. Yeah, that's the theory behind it, and that's what the fund was doing basically. Yes.
When we look at the VIX index, which measures volatility on the S&P 500, it looks like the times of volatility, or when the VIX is high, is actually a narrow window, and most of the time the VIX is fairly low and steady. Just curious, what was your role there at the fund, and tell us a little bit more about how they did the strategy.
My role was I was part of the investment management team, where we basically had to check the strategy that it's working correctly, rebalance also the assets. As I said, when the volatility changed of the assets, you had to rebalance it, and that was mainly the job. That was a team effort. So we did it as a team, and it was also a systematic strategy. So there was no intervention from our side in any discretionary way.
So this was what, you had some sort of system that would tell you, or you had metrics to go by, like
if the realized volatility of the underlying asset was going over a certain threshold over a certain period of time, you would stop investing in it and instead trade out of it and trade into the other assets that showed less volatility.
I see. And the other assets are what, bonds or something else?
Bonds, exactly. Yeah.
Is the goal here to try to really reduce the chance of being hit by a black swan?
Yes.
Is what you're talking about sounds very similar to, I don't know if you've heard of Nassim Taleb. He wrote the book on black swans, and he mentioned this as one of the strategies, the barbell approach.
Yeah.
Overweight, very conservative investments like bonds, and then maybe 80-90%, and then the 10 to 20% you put in much higher risk assets.
That's very much the theory behind it. You also this fund also tried to keep the drawdowns low. Simply because of the mathematics behind it, right? Because if you have, for example, a 50% drawdown, you need 100. You need to make 100% just to get back at break even. Exactly. Yes.
So, what were some of the assets that the fund was investing in on the riskier side of the equation, with a smaller portion of the total assets, like individual stocks or options, or what high risk type assets?
So this fund was quite straightforward in terms of assets, because this was basically the fund was just investing via ETFs into equities and into fixed income also via ETFs. So there were no leveraged products involved or derivatives.
During this time, you're also able to trade your personal account without any restrictions.
That was one of the reasons why I joined this company, because it was possible. For many other companies, it wasn't possible. So they already tell you this during the interview, that you cannot trade any of your positions, or you sometimes also have a minimum time horizon. For example, you have to be invested for at least 30 days in an asset, and you cannot hedge it, and so on. But here it was possible. That was one of the reasons why I joined the company as well.
Did you learn anything at the company that you later incorporated into your own personal trading?
At this company, not too much, because it was a very long-term strategy and it was mostly in equities and bonds. Where I worked later, I worked also at a proprietary trading company where they did quite a few short-term strategies, and that was a little bit of an eye-opener for me, especially in terms of with regards to my own strategy that I was using still.
Tell us, why was it an eye-opener?
It was mostly an eye-opener because that's where I learned what it means to have, there's no official technical term for it, but mostly they refer to it, what it means to have a structural edge, which I would define as understanding your asset in such a way that you know where it's most likely going to go in the midterm and long term, especially. What does that mean? When you look at equity indexes, for example, if you look at the whole history, you will see that they mostly in the US tend to go up over time. If you take a very, very long-term view on the Canadian dollar versus the Norwegian crown, for example, and you plot the chart, you will see that it is highly mean reverting, which also fundamentally makes a lot of sense. Or when you look at the volatility futures, you see that over time, because of the futures decay, it's basically just a line that goes down on a chart. And this is something that they would call a structural edge, where you just know where long-term or mid-term the price of the asset is most likely going to go, completely independent of what the current fundamentals are. And that's something where I really learned it's not going to make sense to try and trade a mean reverting strategy or indicators on a trending asset. It's just not, it doesn't matter. You can tweak it however you want, but it's in the end, if you find something that is profitable, it's likely over optimized. That was basically the most valuable lesson that I really learned. That there's nothing more important than to have a structural edge than to really understand the asset that you're trading.
In our pre-call, you mentioned about part of the strategy, I believe, for yourself or at the fund, was to not reinvest the earnings so as to help reduce the likelihood of getting blown up by a black swan by continually compounding. Could you go more into that?
Some strategies, when you backtest them and you use, for example, a portion of your portfolio size as trading size, for example, you say you want to only risk 1% of your portfolio in every trade. The good thing is that you compound your returns. The bad thing is obviously your strategy always has to work very well in order for you to not have a very large drawdown of which you cannot come out, or you blow or blowing up the account. If you try and trade a purely fixed size strategy, so you trade with in every trade you take exactly the same position size. Let's take let's talk about an example. If you have a strategy that on average per year can make you 50%, but it can also lose 100%. This is obviously a strategy that you cannot implement. However, if you trade this strategy over 2, 3, 4, 5, 10 years, let's say, after the first 2 years, if you made 2 times 50%, you're already up 100%. And since you are not increasing the trading size, even though your backtest showed that maybe once every 10 years, your strategy has that 100% drawdown. You're already up 100%. So even if you have that drawdown, you will just be back at your initial equity. And you can trade out of that drawdown quite easily compared to if you would compound your returns, in which case, whenever you have a 100% drawdown, your account is gone because you're compounding the returns. You're using every time, with every trade, you're basically risking your whole portfolio.
I'd like to dive into the subject of black swans. What you know, what are black swans for our listeners in the financial markets? Why do they even call that?
So basically, black swans essentially are quite rare in real life. And that's basically also why this metaphor is used. Yeah, so black swans are basically just very events that are very rare, that can happen every once in a while. I guess one of the most recent and best examples is probably how assets traded during the Corona crisis, where we saw an incredibly sharp downturn, but at the same time, shortly after, assets rebounded very quickly. So that's I think a typical example of a black swan event.
How do black swan events differ from regular periodic bear markets over time? I mean, aren't the end results the same?
The end result can be the same, but the volatility is much higher. So that's probably where this sentence also comes into play. The market can stay irrational longer than you can stay solvent. So this means the volatility can be so high for a short period of time that you blow your account, even though in the end, you get, for example, a margin call, but in the end, your trading strategy would have actually worked at the end of the year.
Why would your trading strategy work at the end of the year?
Because the assets, that's obviously that is the underlying assumption that has to hold. That's because the underlying asset would mean revert. So, for example, let's stay at the example of the Canadian dollar versus the Norwegian crown, which went up quite a lot during Corona. Here, that's a perfect example where you would see an incredibly high drawdown, which in the end ends up making money, but you have in between an incredibly high amount of volatility. So that's why it would end up making money, because it ultimately mean reverts. Obviously, here the assumption is that it ultimately mean reverts. That has to hold up.
When we talk about black swans, is it a news triggered event, like some unknown or some outside factor that is unknown that hits the markets, and then that causes the markets to go down, or what?
It can be. I think it can also be technically related. For example, we did have in the yen also a flash crash. Also in several stock indices indexes that has happened in the past. I wouldn't call that a fundamental reason. That was just a very quick technical reason, from what I know, why the markets basically traded at a very high standard deviation for a very short period of time. Yeah.
So how do we protect ourselves from black swans?
So this is the best way. It depends. It obviously depends on the portfolio size as well. But the best way would be to use stop losses. That's how I do it with my strategy. So basically, I use a stop loss at which that is systematically set, and at that point I would get out of the trade, no matter what the reason is. It can be a fundamental reason. It can just be a quick mispricing, a technical mispricing, as we've had a couple of times in the past in several assets. So that's how I do it. Obviously, this is very much tied to your portfolio size, because the larger it is, the less likely you are going to get filled at your stop loss. And especially if we're talking about some sort of flash crash or a black swan that happens quite quickly, where liquidity dries up suddenly, the portfolio size makes a big difference. Yes. Here, luckily, when you trade foreign exchange markets, especially G10 FX, which is highly liquid, we're not talking about some exotic emerging market pairs, but about G10, that's quite liquid compared to many other assets.
It doesn't really matter for you then whether the event shocks you or not, or whether you even pay attention to it. You just set your stops in just like you do in a normal market. whether it's no matter what the market conditions are. Uh, are you dissuaded? When would you get back into the position? Or when would you put on positions if you believe that a black swan is underway, or some news event happened that shocked you? What kind of indicators do you look for to get back in the markets?
Mm-hmm. In this case, I would need a new signal, which means the market would have to trade back towards where my take profit is, which is what I use is the average price over a last certain time period. And when it comes back to that, and again trades away from it, and I get another signal, a new signal, that's when I would get in again. So I would actually, so to keep it simple, I would have to wait for another buy signal or sell signal. Yeah, before that
I see.
I would.
So you don't find yourself influenced by the news and the fear of the time. Like, for example, during COVID, when we had the rapid fall of the markets, and then, a lot of fearful news about, this new event that no one was expecting, and people saying, oh, the economy is not going to recover and all that. Do any of those types of news influence you one way or the other? Are you just strictly looking at the chart and nothing more?
It doesn't really influence because this is already, the strategy is back tested throughout several time periods, and especially throughout, for example, 2008, the financial crisis, 2011, the European crisis, then also the crash we had in Chinese indexes in 2015. So as a result, I've sized the strategy in such a way that during a black swan, you would have a large drawdown, yes, but you should usually survive. Your portfolio should survive this. That's why I still trade also during a black swan event. So I don't shut off the strategy. I keep it going in this case because I adjusted the size, so that is highly unlikely that you're gonna the portfolio goes to zero, basically.
So tell us about your sizing technique.
Basically, the way it works, as we just talked about briefly, I use a fixed size trading strategy. So this size really does not change. Of course, the downside is that you don't compound your returns. The upside is that your drawdown compared to your initial equity goes down over time every year, because you accumulate more money, but your drawdowns in an absolute number stay the same. So, for example, let's say you have a strategy that the way you're sizing it, you have a portfolio of 100K. You have a strategy that makes on average 50K per year, approximately 50%. After 2 years, for example, you accumulated 200K. The max drawdown on the strategy was 100K. So let's say after 2 years, you get to that drawdown, you're down 100K, but you still have another 100K. So you're fine on that. Now, after 4 years, in total, you have made 300K. And now the 100K drawdown is not 50% anymore, it's only 33%. And every year, basically, your maximum drawdown, assuming that the maximum drawdown is the historical drawdown. There are some people who also like to, I read a lot that some people like to assume that the next drawdown is going to be 2 times the historical drawdown, which is fine as well. Everybody uses their own assumptions and ways to backtest and to trade their portfolio. But if we stay in this example, the more years you trade this strategy, the lower your maximum drawdown becomes in percentage terms. Obviously, that's a huge advantage, but the disadvantage is that you don't compound your returns. As long as the absolute return is high enough, I would argue that it doesn't matter. That's fine. Then you don't compound your returns. But if you have a portfolio with which you make, let's say, $1 million per year, I think you're still going to be quite happy with the $1 million returns, even though they don't compound. They stay at $1 million for the next 10 years. Yes.
So what do you do with the all the profits that you're taking out? Do you reinvest it elsewhere?
Precisely. Yes. You reinvest it elsewhere, and you
Like
also
where,
keep it in the
for example?
portfolio as well. So because
Uh-huh.
you do want to make use of that mechanism, that in percentage terms your drawdown goes down, but that obviously only works if you keep part of the amount in your portfolio that you make, keep part of the profits within your portfolio, and some part you can also take out, and you can obviously invest somewhere or just save it up. Precisely, yeah, and that's basically what I like to do as well. Yeah, so it's a mix of both.
And so you're doing this just with foreign currencies, is that correct? Mean reversion strategies.
That is currently I'm only doing this with mean reverting FX pairs. Yes, correct. There's also some other interesting mean reverting relationships in, for example, calendar spreads. So that's futures, for example, that expire on with the same underlying that expire, for example, in 1 month versus in 6 months, for example. But that's something I'm not currently trading. I'm currently researching, but yes. So right now it is on foreign exchange pairs and only on economies that are highly correlated. Yes.
Sometimes traders hear the phrase about avoiding fat tail risks. What is this phrase, and what does it mean?
This is where the concept of the stop loss also comes in. You try to avoid very large drawdowns, fat tails, in your distribution of returns, especially for obvious reasons to the downside, because once you're, for example, down 50%, as we mentioned earlier, on the portfolio, you need to make 100% return on that just to get back to break even. That's why I think it's incredibly important to minimize that drawdown as much as possible. In my strategy, this happens over time systematically, simply because I trade fixed sizes. Additionally, in addition to that, I use stop losses, which helps as well. But here I have to say, it is possible, for example, to have a very high streak of losing trades. You can have, for example, 10 trades in a row, and if you risk 5% per trade, then that's already 50% of your portfolio. So a stop loss doesn't just completely is not necessarily the solution. Your strategy obviously also has to have a high enough hit ratio so you can make up the losses.
I said, well, what does that mean? High enough hit ratio, meaning percentage of winning trades, or what?
Yes,
what does that mean?
Yes,
uh-huh.
Precisely. Yes, percentage of winning trades. Yes.
Mm-hmm. So have you had any drawdowns that were significant enough that caused you to change your strategy?
Luckily, not yet. So the drawdowns I've had so far were all within the parameters. We're all within the historical drawdowns. So that has not happened yet. That being said, even though it's highly systematic, the strategy is highly systematic, it is incredible how difficult it is to trade it during a drawdown. Even though you have your historical backtest, you have your assumption, you have your stress tests, you've checked the data, you've checked the fundamentals, you've done all your homework, but especially because in my case, the strategy really trades about 10 times per year on average, approximately once per month, and when you have a drawdown, it takes, especially the length of the trade is still the average trade length of about 1 month, and you just sit there and you have to look at your portfolio for a whole month while it's in a drawdown. And especially when it's a large drawdown, let's say 20%, you do question yourself. You do question your strategy. You question exactly what you just said. You're thinking. You think about, should I maybe change the strategy? Should I change the parameter? Maybe this time it's different. No, I'm smarter than the numbers. I think this time it's different. You have this thought constantly, and that's something that is difficult to work against. But so far it has been possible for me. Yeah.
I see. And during these drawdowns, are these cases where the foreign currency that you're trading gets more overbought or more oversold? In other words, it goes into realms that are extremes on the chart?
Yes, it does. And this is probably a good part to explain how I've also changed the strategy over the years. The strategy itself stays the same, but I've changed the way I entry the strategy. At the beginning, it was very simple. You just get the signal, you go all in, and you get your take profit. You get your take profit level, and you get completely out. Now I usually try to trade in tranches. So I put in first 1/3 of the position side, then 2/3, and then the last third. That's how I do it. And the more it deviates from the mean, the more I invest, basically. So the more you are invested. So that's basically how it works. So when it gets to extremes, that's usually when I invest more size. The downside of the strategy, if you change it like this, is that if you're right on the first position size, you're going to make less money than you used to. But the upside is that you can stomach much larger drawdowns. Yeah. And basically here as well, I backtested the strategy, backtested several ways to average in. And this was one of the best. This was one of the backtests that showed historically the best results, and that's why I'm using it currently.
Now, did you find any other foreign currency pairs that were also good to trade, or did you just stick with the Norwegian currency versus the dollar? I assume that pair?
Yeah, that's versus the Canadian dollar. Versus the Canadian dollar, yeah. This relationship you can also see, for example, with the Australian dollar against the Norwegian crown. You can also see it with the Australian dollar against the Canadian dollar. Both countries are also very heavy commodity exporters, and the currencies tend to be also risk-on currencies. So when everything is good on the market and we have positive news worldwide on a worldwide basis, usually these currencies tend to go up. And when there's uncertainty, these currencies tend to go down. So this correlation also creates this mean reverting tendency of the cross pairs. Yeah.
Is any part of your strategy discretionary?
Not really discretionary. No, I would say this is where it gets a little bit tricky. In my opinion, discretionary traders are systematic traders, and systematic traders are discretionary traders. Me implementing this systematic strategy is a discretionary decision. I said, okay, I'm going to do my analysis fundamentally, technically, and then I will decide if I trade this or not. So I'm doing a discretionary decision when I say I think that these economies are highly correlated, and I think it will stay this way for the next, let's say, 12 months. And then in 12 months, you reevaluate as well. And if you still think that for the next 12 months, the economies will stay highly correlated, then you keep on trading the strategy, basically. The execution itself is completely systematic, but I think simply deciding that you want this, that you're going to implement this strategy is a discretionary decision. But to answer your question, it would be categorized as a systematic strategy. Okay. It's just my own opinion that it's also discretionary in nature.
Yeah. So as we're doing this interview, crude oil is near multi-year lows. What are you seeing in the foreign currencies right now with regards to this, to these extreme prices? And is it playing out kind of the way you're anticipating?
So that's a good, that's an excellent example. Currently, for example, if you look at the Canadian dollar versus the Norwegian crown, you will see that it's trending downwards. And this, in my opinion, has more to do with the tariffs, that the news about tariffs that we get from Trump currently. So this is where you see how it's why it's deviating so much from the mean currently. And
well, okay, so just to interject here, we're talking about the Canadian dollar versus the Norwegian crown. Which is going up? Which currency is very strong right now?
Yeah. So the Canadian dollar is falling against the Norwegian crown.
And why is that? But both countries are big oil producers,
Mm-hmm. Yeah,
right?
precisely. But there's another variable, and that's currently the tariff talk that we have.
Uh-huh.
That yeah, the current U.S. president is imposing the tariffs against Canada, and that's also where we see a weakness in the Canadian dollar, which is now causing the FX pair to deviate from the mean, which is in my case it's something good because it gives me a trade opportunity. So right now I just got a long signal, and I would put in the first position now, and then if it starts deviating more, I put in the second and then third position, and if I'm less lucky, it just stops deviating immediately. Then I still make a profit, but not as much than if it would deviate more.
I see. So you're going long the Canadian dollar. Is that correct?
Correct. Long the Canadian dollar. Yeah.
Because it's oversold versus the Norwegian currency, correct?
Correct. Yes.
I see.
Exactly.
So these correlations, given that the foreign currency markets are extremely competitive, what stops big firms from jumping in on these type of correlated trades and just overwhelming the market with this? Is there an issue of not enough liquidity? It sounds like what you've come across here is a high probability play.
Yes, it is. I would call it a high probability play as well. The issue here is one is liquidity. So a large company, the Canadian dollar definitely is very, very liquid, and in general G10 FX. But the Norwegian crown, probably within G10 FX, is one of the least liquid. So this prevents very large institutions to trade big sizes in it. That's first of all. And second of all, I also think that it's a strategy that is not very common to trade these currencies, I would say. Most investment funds, large investment funds, would rather invest long term in equities, for example. The short term players, the prop trading companies and the hedge funds, I don't think it's enough size to completely stop the strategy from working. Mm-hmm. That's what I would assume that is one of the reasons. Yeah.
Mm-hmm. A few years ago, I interviewed a FX trader who says that the sharks in the game take a look at where all the stop losses are placed, both on the upside and on the downside, and they routinely engage in stop loss hunting to flush those players out, and then take the opposite position after they've flushed them out. How often do you encounter, or have you encountered, obvious cases of stop loss hunting in your experience?
I think in my case with the strategy, I'm quite lucky because I don't look at precise technical levels where I would say if yesterday's low is taken out, that's where I get out. That's where I set my stop loss, for example. I set my stop loss simply using a multiplier of how many, in currencies we would be talking about cents, how many cents the price is away from my entry price. And that's where I get out. But that's without looking at any precise historical level where you would see maybe, okay, he traded a lot in the past, or there is resistance or support or anything like that. I don't use that. That's why I would say in my case, this strategy doesn't affect me.
So net your stop losses are typically kind of what percentage range away from your entry point?
Yes, not a percentage rate. It's an absolute value, so it's a term of cents. That's how I calculate it. Yes.
Oh, I see. But what does it translate to in percentage terms? Usually, I mean, are you having really wide stops? Typically 10% or more, or your stops pretty tight?
Yes, yes. They're actually very wide. They're around 10%. You could probably get to 10% approximately. Yeah. Exactly.
I see. I see. To wrap things up, what do you struggle with most as a trader?
Hey guys and gals, it's Tessa. Sorry for the interruption. This is going to be quick. These interviews take time and dedication to do, and honestly, we hardly make any money from it. Enough to cover expenses of running a podcast, though. But we do it because we love contributing to the trading community, and all we ask from you, our dear listeners, if you love Chat with Traders, please be generous and give us a like and subscribe to our channel and tell others. This can be your way of letting us know that you love the podcast and so that we can keep it going on forever. No, just kidding. Not forever, but for as long as we can. On behalf of my co-host Ian Cox and I at Chat with Traders, thank you so much. Now back to the show.
I think what I struggle with most, trading related, would be this is a mean reverting strategy, which means usually you have a very high hit ratio, but your average drawdowns are larger than when you use a trend following strategy, where you often cut your losses very quickly, and you let your winners run for a long time. I think this is something where psychologically it's a little bit more difficult because you have larger drawdowns and you have them more often. Overall, in the end, you hit your take profit far more often than with a trend following strategy. However, in between, you have more drawdowns and larger drawdowns, and that's something where I think psychologically this is quite difficult, because you have this constantly. So the strategy does about 10 trades per year, so once per month approximately, and you have this every month. So I think this is something where I would say it's easy to struggle with a lot. But once you get used to it, and especially when you trust your strategy, you've done your research, this helps a lot, I think, to use the strategy correctly.
And how long have you been doing this particular strategy? You said since 2012 is when you first started, or 2000, right around then?
Yes, correctly. Yes, since then. And I've been trading this strategy where I changed the entry logic for approximately 2 years now. Yeah.
Is there anything else that you're working on that's inspiring?
That's a good question. I've been doing some research, especially regarding, I've read something, a very famous page now from a book that was written by Ray Dalio, that shows how diversification is the holy grail that you can find, because it can help when you find several strategies that are not correlated and you add them to one portfolio, that your overall drawdown, you can reduce your overall potential drawdown dramatically. And this is where I'm researching as well some trend following strategies, especially in assets where you can see that they are long-term structurally trending. For example, equity indices. If you look at on a daily basis, when I'm not talking about an intraday basis, but daily candles, you can see how it trends long-term upwards. Also, when you look at weekly candles, and this, for example, would be a great complementary strategy with the one that I'm currently implementing, because, well, yeah, you can basically reduce your drawdowns, right? So that's what I'm currently working on. It's basically I'm backtesting trend following indicators on a trend following asset in a trend following time frame. That's the basic idea behind it. And by adding this strategy to my portfolio in the future, it will be possible to reduce drawdowns. Obviously, here the assumption has to hold that in the future, the asset will keep on trending and not become suddenly a mean reverting asset. Yeah.
Well, Christian, I'd like to thank you for coming on Chat with Traders.
Thank you. Thanks a lot for having me.
Yeah. How can our listeners reach you?
Yes. So they can reach me easily on X. And my handle is ChristianRM_5x8.
Great. Fantastic. Thanks for coming on the show.
Thank you.
Hey there. There were some additional parts of our chat that didn't quite make it in the main part of the interview, but we included it here at the end for those who made it through the end. This is where I asked Christian about the World Cup Trading Championship competition and his thoughts on the strategy he used for the competition versus the strategy he uses in his actual personal trading.
I think these championships, you definitely, on average, have to take more leverage than you would usually do, which implies also a larger drawdown than you would usually have, a potential larger drawdown than you would usually have. Why? Because, I mean, you see it in the returns as well. People have in one quarter 3-digit returns, like over 100%. Sometimes even over 300, 400%. Also in the yearly competitions, you also see sometimes people having 1,000% return. So very often you leverage more than you usually would. So that's one important thing to consider when you see these results. And there's another thing that I would definitely like to mention. Without knowing it 100%, because you don't know what strategies every single winner has used, I believe such short-term contests are very favorable of mean reverting strategies, because usually your wins are more frequent than with a trend following strategy. With a trend following strategy, on average, you can have maybe a whole year where you only get stopped out with very small losses, so you don't have a huge drawdown, but you obviously didn't make any profits that year. And then the next year, you could have a year where you make 100%. However, with mean reverting strategies, the profits are usually far more constant. So from having that in mind, it's very likely that most winners of these of any kind of short-term competitions use mean reverting strategies. So that is something that I have seen as well, just from my own experience as well, because I also trade mean reverting strategies. Yeah, that's just an additional information that I would like to share, I think.
So during this contest, did you take on quite a bit more leverage than you normally do?
Approximately twice as much leverage.
Mm-hmm.
Yes.
Mm-hmm.
So that was necessary in order to get the returns. In my case, I actually also started the trading competition late. I only had half the time than the other participants. So as a result, that also was a reason why I had to use higher leverage. Yes.
Did you learn anything from this competition, and did it impact the way you trade normally?
I think what I definitely realized is that I think it depends also on everyone's personality. Some people thrive in competition, some people less. But what I've learned is that I was far more comfortable with taking larger position sizes once I was already in profit. There's a huge difference between starting the year, you have 0% returns, and then you take on a position that could potentially cause a 10% drawdown. So there's this scenario. You have zero performance for the year so far, and then you could potentially use 10% on the next trade, or you're already up 20% and you could lose 10%. Then you would still be up 10% overall. And this is where, especially in these competitions, you tend to say, okay, I'm up 20%. Let's risk these 20% for the next trade, so you can potentially make a higher amount, a higher return. But if you lose it, you just break even. So this is something where that I usually don't do with my own systematic strategy, because it's highly systematic, also the position size. But in this competition, you have to do in order to get to the high returns that you usually see in these competitions. So this is something that I definitely learned during the competition. I really started to applying what I previously read about some discretionary traders, that they tend to increase the trading size when they have had a lot of winning trades. that's something that you have to do in these competitions, in my opinion, as well, in order to get these huge returns to win the competition. Okay, so what's the interesting part about this? Psychologically, I traded simply by focusing on my equity that is at risk. So once I was up 30%, I was completely fine with taking a larger risk. If on average, let's say my trade, I risk 10% of my portfolio, but I'm already up 30%. In this competition, I would say, okay, so I'm already up 30%. I'm fine with just breaking even. So let's risk those 30%. So my potential profit is much, much higher. It's 3 times higher than my average trade. But the loss that I have, yes, in percentage terms, it's higher. It's 30%. It's also 3 times higher than usual. But if you look at your equity, you're going to break even. And that was something that I was focusing on, that I usually don't focus on my systematic strategy. But in these competitions, I think simply from my own way of trading, I can imagine that many other people also trade like this during these competitions.
I see. And so would you apply these to your real life trading?
I wouldn't in my case, simply because that's likely the psychological part of myself. I do like having rather consistent small returns than having every now and then huge returns, which is more like a trend following or swing trading approach. But that's just psychologically how I like to trade. Okay.
Question for me. I'm just curious. So you came in second place for that championship. What prizes were there? What did you win? What did you get out of that?
So in these this trading competition, this is basically the most famous trading competitions. There are several also for FX, but this is the most famous one for futures and FX, and that's why many people participate in it. I mean, it's also the one that, for example, Larry Williams won. Paul Tudor Jones also was participating in this one.
Oh, the US championship one? The US
Yes.
IC? I know that one. Yeah.
Yes, exactly. But not for equities. That's the one for FX and futures. Yeah.
Oh, I see. What kind of prizes were there for winning?
Yeah. There's no official prize that you get. So there's no what you get is the trophy.
Uh-huh.
Yeah. But especially also you basically you get to a pool also of recognition, and also you get to a pool of previous winners that you can exchange ideas with or simply network with. Yeah.
Awesome. Are you going to join again this year?
Probably yes, but I will be joining for the third and fourth quarter championships again. Yes.
Okay, and just for the audience, what's the name of the contest again?
It's called the World Cup Trading Championships.
For Forex.
For Forex in this case, yes. When you go to the standings, you can see that there is a futures table and a foreign exchange table where you can see the traders for foreign exchange and the ones for futures trading. Yeah.
Awesome. Well, congratulations for last year's and good luck for this year's.
Thank you.
Yeah. And here I also asked more about the reasons behind his website, globalfxanalytics.com, for a little bit more context.
I've worked institutionally in FX trading, and I've seen that there's quite some offering for long-term equity strategies for retail traders. There are some good online courses that you can do. A lot of groups as well that have a great historical track record. When you look for foreign exchange, especially for retail, it's not very easy to find anything. And with my experience, I thought I can share this in a format as of a course, for example, or a Telegram group that is currently also very popular. That format, and just share my knowledge and my trading strategy in foreign exchange, especially because I saw that it's very difficult to find somebody who is offering a profitable strategy with a track record in foreign exchange that also knows about fundamentals, knows about technicals, actually understands why the strategy works the way it works. That's quite difficult to find. In equities, not so much. There I actually was able to find relatively quickly quite a lot of offerings, but for a foreign exchange, it was almost impossible. And that's why that's where the idea came from, that I would like to share my knowledge, share my strategies, especially because the type of strategy that I trade, luckily, doesn't. If a lot of people would implement it, I don't think it would just suddenly stop working. The currencies wouldn't simply stop deviating every once in a while, and that's why I think there's no problem to
share,
to show it, to share. Exactly. Yeah, precisely. So that's the idea behind it. And the initial thought was to offer it via copy trading.
Mm-hmm.
Now I've also extended it to a Telegram group, and I'm very likely going to also implement this with a course. Why? Because I'm getting so many questions on the strategy, that I think it would make a lot of sense to also offer a course here.
That's a lot of work, trading and also offering this service. That's cool,
yes. But the good thing is, since it's a long-term strategy, it's not that time-consuming. So you can really run this strategy easily with just a few hours per week.
Yeah.
So that's a good thing. Very, very much like certain swing strategies, for example.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.